Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is February 13th, 2025. I'm excited to dive into today's market updates and news, so let's get started with a quick overview of where the markets stand this morning.
Overnight, the S&P 500 is trading at approximately 6,068. We saw a modest gain of about 0.12%, which suggests investors are cautiously optimistic as the trading day unfolds. Meanwhile, the Dow Jones closed near 44,442, up by a mere 0.03%. The Nasdaq, which tends to give us more insight into tech momentum, is sitting around 19,761, up by roughly 0.32%. The Russell 2000 is performing in a similar vein at about 2,256, with a gain near 0.23%.
Shifting our gaze to the cryptocurrency landscape, Bitcoin is trading at approximately 96,596, down by nearly 1.94%. Ethereum, too, is facing some headwinds, currently at about 2,647, down by roughly 3.3%. It appears that as traditional equities creep higher, the cryptosphere is enduring some corrective pressure, fueling conversations around volatility and investor sentiment in both markets.
Now, before we turn our attention to the deeper market trends, let's take a moment to recap what this modest yet intriguing performance might indicate. The general pattern across these key indexes shows slight gains in traditional equities, but when it comes to crypto markets, there appears to be a more significant pullback. This dichotomy might be reflective of investors shifting their focus amid increased uncertainty in several areas of the broader economic landscape. It seems like while the technology and growth sectors are holding their ground, at least for now, the digital currency space is reminding us that high volatility is part and parcel of its territory.
Let's dive deeper into the major market trends that have been dominating headlines. One recurring theme you may have noticed is the talk about tail risk. Multiple articles underline how uncertainty stemming from inflation, unpredictable tariffs, political disruptions, and even global events could potentially trigger a chaotic downturn in the market. There's a consistent narrative pointing out that while the bull market might look robust from afar, there are underlying pressures that might tip the scales if these unpredicted risks materialize. As investors, we've long known that risk maneuvers in the form of tail risk, although statistically unlikely, can have outsized impacts. No matter how cautious we become, Mother Nature has a way of reminding us that even in the calm before the storm, intense weather can brew unexpectedly.
Alongside this, we've seen repeated mentions of rising wholesale prices, particularly pointed out by the surge in the producer price index early in this year. The articles highlight that these rising prices are strong indicators of persistent inflation pressures gnawing at the guts of the United States economy. It's a classic case of cost-push inflation, where increases in production costs, whether due to raw materials or labor expenses, are inevitably passed down the supply chain, eventually affecting consumer prices. This development has market watchers concerned about the Federal Reserve's next moves regarding interest rate adjustments. Inflation, as we all know, is a bit like that awkward guest at a party who simply refuses to leave. Even if you try to ignore it, it continues to make itself known in the background.
The conversation doesn't end there, however. Another hot topic that's been making rounds is the interplay between traditional finance and the digital currency world. There's been a flurry of commentary on how high-profile figures, notably former President Trump, are positioning themselves in the crypto landscape. One of the repeated headlines emphasizes that while cryptocurrency adoption continues to accelerate, corporate balance sheets in America hold trillions in cash and bonds that have yet to find a home in the crypto portfolio. It's like witnessing a tug-of-war between the old guard and a rapidly evolving financial paradigm. On one hand, we have tech-savvy investors betting on a decentralized financial future, and on the other, seasoned institutions sitting on massive reserves, seemingly waiting for the right moment to dip a toe into crypto. It's a classic case of if you can't beat 'em, join 'em, but only if you're sure that the risk-reward balance is favorable.
One might say that fiscal prudence meets disruptive innovation in an intriguing dance, one that could redefine what we expect from corporate capital allocation in the years to come.
And then there's the world of cybersecurity and mergers and acquisitions in the tech space. CyberArk, a well-known name in the security domain, has recently acquired Zilla Security for roughly $165 million in cash. This move underscores the increasing importance of robust cybersecurity measures in today's digital-first economy. With cyber threats on the rise and the financial stakes higher than ever, companies are not only investing in technology to secure their data, We are also actively seeking to integrate innovative security solutions through mergers and acquisitions. These strategic moves suggest that cybersecurity is no longer just a cost center. It has become a vital strategic asset that can define a corporation's competitive edge in an increasingly digital corporate landscape.
Now let's step back and synthesize what all of these stories mean for our broader market trends and the sectors most affected. The recurring theme of tail risk and its potential impact on the market naturally puts a spotlight on sectors that are either resilient to economic shocks or possess significant defensive attributes. Financials, for instance, are grappling with the dual challenge of managing credit risk while also adapting to an environment where regulatory scrutiny may intensify. Investors are eyeing sectors that traditionally respond well to inflationary pressures, such as energy and commodities. At the same time, the tech sector, while driving much of the Nasdaq's performance, must remain agile in the face of rising supply costs and geopolitical pressures that can disrupt global supply chains.
Consider the tech sector, where a blend of cutting-edge innovation and steep competition sets the stage for both explosive growth and sudden downturns. The Tesla of risk management, if you will, is trying to keep pace with rapid technological advancements and an accelerating pace of change. The tech companies that can effectively navigate these headwinds, perhaps by increasing investment in cybersecurity defenses, as evidenced by CyberArk's bold move, stand to not just survive but thrive. It's almost like watching an intense game of chess, where each strategic acquisition or innovation move could either solidify a company's position or expose it to new vulnerabilities.
Turning our gaze to energy and commodities, these sectors often provide a sanctuary for investors during times of market uncertainty. When inflation starts to paint the economic picture in bold strokes, energy stocks tend to see renewed interest. Rising input costs, escalating production expenses, and geopolitical tensions in resource-rich regions all contribute to a scenario where the price of oil and gas becomes a focal point. The interplay of supply and demand here is nothing short of dramatic. Imagine a slow-burning thriller where every twist in global policy or environmental regulation rearranges the pieces on the board.
Then there's the financial sector, a realm where balance sheets, risk management, and compliance are the themes of every conversation. In today's environment, where uncertainties hover like a persistent fog, banks and financial institutions are sharpening their risk models and reevaluating their exposure to potential economic shocks. The specter of a tail risk event, as mentioned earlier, is prompting a wave of cautious recalibration. It's as if the financial sector is gearing up for its own winter is coming, ensuring that its portfolios are liquid enough to weather any storm.
Now let's expand our view to global market implications. It's important to note that while domestic headlines often steal the show, the interconnectedness of today's global economy means that events in one corner of the world can send ripples far and wide. Take, for example, the persistent inflation pressures highlighted by the rising wholesale prices in the United States. This trend isn't confined to a single nation. It has the potential to influence global commodity markets, trade balances, and even the currencies of nations that rely heavily on exports. Investors around the globe are watching closely, wondering if the inflationary trends in one superpower could catalyze similar adjustments abroad. It's a bit like watching a row of dominoes. Once the first one falls, you know the rest are coming too.
The burgeoning debate over cryptocurrency's role in the financial ecosystem also has international repercussions. Countries across Europe, Asia, and even emerging markets are grappling with the challenge of regulating digital currencies while also exploring the potential benefits of blockchain technology in boosting transparency and efficiency in both public and private sectors. The narrative of former President Trump's active involvement in the crypto scene isn't just fodder for domestic headlines. It serves as a case study for how influential figures can sway the narrative in any economy that is mindful of innovation and disruption. For global investors, the key question remains: how fast can the traditional financial architecture adapt to embrace this new decentralized paradigm without compromising on security or stability?
Let's take a moment to talk about expert insights and predictions. In our discussions with several market strategists this morning, a recurring sentiment has been one of cautious optimism. There is growing consensus that while the markets currently appear to be on a modest upswing, the underlying uncertainties, what we're referring to as tail risks, are not to be taken lightly. Experts are emphasizing the need for a balanced portfolio that can weather abrupt shifts in the economic landscape. Some even liken the current market structure to a meticulously prepared meal. On the surface, everything seems well balanced and appetizing, but there's always that unpredictable ingredient that could either add a surprising zest or spoil the entire dish.
A few of our colleagues humorously remarked that trying to predict market behavior today is a bit like forecasting the weather in a town where it rains on sunny days and shines on rainy ones. It's exactly that mercurial. Most of the analysts we spoke with agreed that while it might seem tempting to chase every minute uptick in the stock indexes, investors should do well to focus on long-term prospects and stay disciplined in their investment strategy. After all, the market's mood swings can sometimes be as dramatic as a daytime soap opera, and who among us doesn't enjoy a good plot twist every now and then?
Let's now break down some of the specific headlines that have been making waves today. First on the list is the repeated headline about the stock market ignoring what could be its number one threat: the tail risks lurking behind inflation, tariffs, political chaos, and other unknowns. It's not every day that you come across an article that gets repeated 3 times, which tells you something about the level of concern surrounding these issues. The idea here is straightforward. While the markets have flirted with positive gains, there's an ominous sense that perhaps not enough weight is being given to the proverbial elephant in the room. Is the market's current calm simply the eye of a hurricane waiting to burst forth? That is a question every investor should be asking.
Then we have the set of stories focusing on wholesale prices and the persistent inflation pressures in the heart of the United States economy. With producer price indexes rising sharply, the conversation shifts toward the sustainability of current profit margins across industries and whether companies can absorb these rising input costs without passing them entirely on to consumers. The takeaway here is one of caution, a gentle reminder from the marketplace that while growth is desirable, unchecked inflation can destabilize even the most robust economic systems. Imagine trying to enjoy your favorite cup of coffee only to find that the price has doubled overnight because of escalating production costs. It's a scenario that will keep both consumers and investors up at night.
Our third group of headlines centers around the seemingly paradoxical movement in the crypto space, with former President Trump taking a keen interest in cryptocurrency and Bitcoin bulls, betting that America's corporate balance sheets hoarding trillions in cash and bonds are the next frontier for crypto adoption. We are witnessing a fascinating clash of ideologies. On one side, you have crypto enthusiasts arguing that decentralized finance represents the future, and on the other, traditional financial institutions seemingly content with their conventional asset allocations. The discussion isn't about whether blockchain technology is revolutionary, it certainly is, but about how quickly, or indeed whether, large institutional investors will begin to allocate these dormant pools of capital to digital assets. The stakes are high, and the outcome could very well reshape the financial landscape as we know it.
Lastly, let's discuss the cybersecurity realm, highlighted by CyberArk's acquisition of Zilla Security for approximately $165 million in cash. This move is not just a routine corporate acquisition, it's an indicator of the premium placed on security in an era where cyber threats are evolving at breakneck speed. While the dollar amount might seem like just another figure on a corporate balance sheet, it symbolizes a broader trend. Companies are stepping up their game in the cybersecurity domain, recognizing that a single security breach can have catastrophic consequences far exceeding the acquisition cost. It's a timely reminder that in today's digital economy, investing in robust defense mechanisms is as essential as investing in growth.
At this point in our conversation, you might be asking yourself, what do these developments mean for the average investor? Should you be reallocating your portfolio towards seemingly safer assets, or is this the moment to ride the volatility of tech stocks and cryptocurrencies? Well, as always, the answer isn't one size fits all. Diversification remains the golden rule of investing. A balanced portfolio that manages exposure across equities, tech, energy, and even a sprinkling of digital assets ensures that you are well protected against sudden market reversals. It also provides an opportunity to capture growth in areas that might act as counterweights to rising inflation pressures.
Let's now shift our focus to a detailed sector analysis. In the technology sphere, the markets continue to marvel at the relentless pace of innovation. Companies in this sector are not just developing new products, they are reinventing entire business models from the ground up. However, rapid innovation comes with its own set of risks. For instance, supply chain disruptions fueled by geopolitical tensions and unexpected regulatory changes can impose significant challenges. Even though tech stocks have been relatively robust, recent trends such as the rising wholesale prices signal that cost pressures could erode profit margins if companies don't manage their operations effectively. Cybersecurity, as evidenced by the recent strategic moves by companies like CyberArk, is now at the forefront of every tech firm's priority list. It's almost as if we're reminded that in the digital age, an ounce of prevention truly is worth a pound of cure.
The energy sector is another area where the narrative is evolving rapidly. With global uncertainties and heightened geopolitical risks, energy stocks often serve as a barometer for broader economic health. Recent moves in this sector indicate that investors are leaning towards companies with strong fundamentals that can withstand the volatility associated with fluctuating oil and gas prices. Some energy giants have even begun to explore renewable sources, blending traditional energy investments with the promise of a sustainable future. It's a tale of two worlds, one rooted in conventional energy sources that have powered industries for decades, and the other pivoting towards renewables that promise a cleaner, albeit initially more volatile set of returns. Over time, the energy sector's adaptation to changing global trends will be a fascinating story to watch.
Then we come to the financial sector, where the interplay of risk management, asset allocation, and regulatory pressures defines the landscape. Financial institutions are increasingly contending with a dual mandate to fuel growth while hedging against potential market shocks. The discussions around tail risk are particularly relevant here as banks and financial institutions fortify their balance sheets against unforeseen events. Interest rates, inflation pressures, and global trade uncertainties have all added layers of complexity to their operational strategies. Investors in this space are advised to keep a keen eye on the evolving regulatory environment, as even minor shifts can have sweeping implications for profitability and market positioning.
Expanding our horizon further, let's discuss the global implications of these developments. When tail risk and inflationary concerns dominate discourse in the United States, inevitably, other markets take notice. European markets, for instance, have been watching with a blend of intrigue and caution. While some believe that the measures taken by the Federal Reserve could eventually allay inflation fears, others worry that sustained price increases could spark similar challenges abroad. Emerging markets are not immune either. Many economies already grapple with inherent vulnerabilities that could be exacerbated by persistent inflation pressures. The question on everyone's mind is, how will these macroeconomic challenges shape trade relations and capital flows across continents? It's a question that demands careful consideration, especially in an era where economic policies and global supply chains are more intertwined than ever before.
With such a complex backdrop, expert insights and predictions become vital in guiding our next moves. Many financial strategists are calling for a balanced approach. One recurring recommendation from our expert circle is to adopt a multi-layered investment strategy embracing equities, cautiously exploring the crypto space, and ensuring that the portfolio is hedged against potential market downturns. There's an increasing sentiment that while the market's near-term performance remains positive, the real test will come when those tail risks materialize. It's a bit like savoring a delicious dessert while keeping an eye on the kitchen timer. Enjoy the moment, but always be prepared for the unexpected.
I'll throw in a bit of humor here. If you ever feel like the market is as mysterious as a magician's hat, remember that even magicians can't pull a rabbit out of thin air every single time. Sometimes you get a gov, sometimes nothing at all, and that unpredictability is precisely what keeps us all on our toes. It's a reminder to not take any single trend at face value, but to keep interrogating the data and questioning the wisdom of the prevailing narrative.
As we reflect upon these market stories and sector analyses, several thought-provoking questions come to mind for you, our listeners. Is the current modest uptick in the traditional equity markets merely a temporary high before the storm of tail risk arrives? Can the tech sector maintain its upward momentum while grappling with rising input costs and tightening supply chains? And importantly, will the promise of revolutionary blockchain technology adequately lure those vast corporate cash reserves into the crypto market? These questions invite us to dig deeper, constantly evaluating our portfolios and strategies in a landscape that is as dynamic as it is unpredictable.
Before we wrap up today's briefing, let's quickly summarize some key takeaways. Firstly, while the S&P 500, Dow Jones, Nasdaq, and Russell 2000 are all posting slight gains, indicating a general mood of cautious optimism, the cryptocurrency space is experiencing a notable pullback. Secondly, repeated headlines on tail risks serve as a timely caution reminder that despite apparent market calm, underlying uncertainties could lead to significant market shifts if left unaddressed. Thirdly, the rise in wholesale prices signals persistent inflation pressures, which could force companies in various sectors, from technology to energy, to adapt quickly to maintain profit margins. Fourthly, the evolving dynamics in the crypto space, particularly the debate around the integration of digital assets into corporate balance sheets, highlight a potential paradigm shift in financial strategy.
And lastly, strategic moves in the cybersecurity domain, such as CyberArk's acquisition of Zilla Security, underline that in today's digital economy, security investments are paramount.
Throughout this conversation, we have explored a multitude of factors, from market performance and sector-specific challenges to global economic implications and expert predictions. The interwoven narratives of cautious optimism amid potential turmoil, the balancing act between digital innovation and traditional fiscal prudence, and the emerging geopolitical and inflationary challenges all paint a picture of a market at a critical juncture. It certainly gives you a lot to ponder as we navigate these exciting yet unpredictable waters.
I want to thank you for spending this time with me on the PAI Morning Briefing. Remember, Pantheon AI is your information co-pilot, here to help you make sense of the stormy seas of global finance. As you reflect on today's insights, I encourage you to ask yourself, how prepared is your portfolio for sudden shifts in market sentiment? Is there a balance in your investments that can weather both the calm spells and potential storms? And what steps might you take today to ensure your financial strategy remains robust in the face of emerging tail risks?
As always, we value your questions and encourage you to reach out to our AI Copilot with any queries or if you need further clarity on any of today's topics. Learning should NT feel like a full-time job, so let us help you manage the heavy lifting of market analysis while you focus on making informed, strategic decisions for your future.
Thank you for tuning in to today's briefing. I invite you to come back for our next episode tomorrow as we continue to explore the complexities of the market and provide actionable insights that can help guide your investment strategies. Until then, stay curious, stay diversified, and above all, stay engaged with the pulse of the market.
Once again, this is your host from Pantheon AI, reminding you that in the world of investing, every day brings new challenges and opportunities. Keep asking the right questions, remain adaptable to change, and remember that sometimes the most significant growth comes from navigating uncertainty with a clear, informed perspective.
I look forward to our conversation tomorrow. Have a fantastic day ahead. And remember, learning should NT feel like a full-time job.